Okay, so good evening, everyone. Welcome back to another session of IBS case studies. Today, we are going to cover again two case studies. Myself, I am Amit Kumar Rathore, and if you attended the previous batch, then you already know me. I am uh, from a firm which is actually into the top 10 firm. I'm working in the statutory audit division as a director in the position, and I have experience of around 15 years in the statutory audit only. I have experience of three big fours. I've spent around 4 years with Deloitte, 3 years with EY, and 6 years with KPMG. So we can move to the case studies. These case studies as an IBS exam, as we mention it in all the case study sessions, that this is really very important. Whatever we are going to discuss in these case studies, it should be actually considered like a professional case study. So it is a situation, a practical situation that is given by the client to you guys, and then you as a professional, you have to convey, you have to give your advices, your consultancies over the problems, over the situations that the client is going through. Whenever I go through any of the case studies which are being compiled by the ICAI for the practice purposes, there is always something new. There is always some sort of learning from those case studies. Considering so many years in the industry, we know that knowing everything is impossible. All we need to do is to stay hungry, stay foolish. We always should have an open mindset towards learning to gain the knowledge and everything. And these case studies, they always help us building our mindset. They help us giving that particular perspective that there are new areas which we are either unaware about or that have been left untouched. As a professional, obviously, when we think about growth, we grow as a team. We can't grow as an individual because individually there are so many things which are going on which will become very difficult to kind of capture. So when you are thinking from that particular perspective, IBS, as you all are aware already, is an open book examination. The purpose of this open book examination is actually to let you know that in the practical scenarios, in the practical world, we have this kind of an opportunity. We can leverage on the resources that are available with us. So if a client is asking for a particular situation, may not be, I mean, always in a position to answer, and that is very much practical. But you should always be, as in qualified, as in professional, that you should always be aware that where the answers can be, so that after that meeting, after that requirement, after that kind of consultancy that the client is seeking, you can go back to the right resources, you can go back to the right professionals, you can search through the right material. So if you are aware that what is the right material, where it is available, definitely it will help you in the practical world as well. And IBS is actually giving you that kind of an exposure, that kind of an experience that you all can leverage. So in today's session as well, as usual, we are going to cover two case studies. Both of these case studies are again very critical in nature, and we will go one by one to both of them. They will help you understanding some of the costing kind of concepts, and then some of the accounting or auditing related concepts. I mean, you see, when a client is providing you a kind of a situation, when a client is running a company, a business, and then they are approaching you, a company and business, they don't face problems thinking that there is a specific kind of a service line where they'll be facing problems. All the problems that they are generally facing, they are interlinked. They are interlinked with various subjects, various concepts that you have already gone through or you will be going through. So as a professional, we need to know how to interlink all the concepts, everything that we are studying around. And these case studies actually give you that opportunity. They give you that learning that how to actually club or compile all our learnings and prepare a solution or prepare a kind of a consultancy for our clients so that the clients can value that consultancy, and then we can succeed in our career. So moving to the first case study, I'll quickly request anyone to kind of just confirm if my screen is visible so that we can start discussions around it. Technical team, is my screen visible? Perfect. So the first case study that we are picking up in today's class is about Cycles India Limited. Okay. So this particular case study is actually about a manufacturing entity which is into the cycle manufacturing. So this is basically from an industry of manufacturing. Each case study itself has different industries. So when you go through this case study modules, the compilation that the ICAI has done, you will have understanding of various industries as well. You will get to know how various industries are working, how an FMCG industry is working, how the manufacturing or the service industries are different from each other, how the other industries in terms of e-commerce giants or probably the oil and gas industries they are working. Considering the global scenarios, you all are aware what is going on in the global economy. You know, as a professional, we can see, we should foresee the future, and when we can see that whatever is going on around, how it is going to impact various industries. And to understand that, we need to have the understanding of various industries. Like if there is a public news which is going on nowadays that the oil prices will touch $150 as well. I mean, I was just having a discussion with somebody from the Shell. Shell is a oil company you guys are already aware about. So I was surprised to know that when they started their projections for this current year, the projections started with somewhere around $60 per barrel. And now you won't believe it is already touching $100 per barrel. And this is what nobody predicted, that what will happen in the global pandemic kind of an environment, global environment, and how this geopolitical situations that are going on around will impact the oil prices. So while on the other side, the other industries which are based on the oil, it can be any industry. I mean, it can be petroleum, paint industry, it can be fertilizers, it can be electricity generation. It can be any industry that is directly indirectly is impacted. Transportation is an industry. And that's how when the oil prices are increasing, it is impacting everything around. And all these industries, they are sitting at a higher cost. And because of which the prices of the products or services are also increasing. So while the prices are increasing, the profit is not increasing for these companies, and that's why the inflation is kind of going rooftop. So when we understand all these industries how they are working, we can definitely see that the global kind of economic systems they are impacting different industries in different manner. And these case studies, they give you a insight of various industries. They tell you actually, how the industries are working. So in the today's kind of session, we are going to discuss two separate industries. One is the cycle manufacturing industry. So this case study 21 is all about cycle manufacturing industry. So in this particular case study, we are talking about Cycles India Limited, which is CIL, and this particular company is actually into manufacturing of various cycles. They are manufacturing the cycles for both adults and children simultaneously. Given below is the information about cycles made for children. So this particular table that you are looking at, this is about the cycles which they are making for the children. So this is one of the segments that they have. Now they are talking about that what is the monthly demand and production, and the costing that they have come across. This costing is absolutely on the basis of two different methods. You see, the first method is basically it is known as traditional cost, volume, and profit analysis method, which is CVP model. So this is in the manufacturing industry. It is known as CVP model, whereby we are just checking how the cost and the volume is impacting the profit. This kind of analysis is there. While we have another way of doing the CBP analysis, which is known as activity-based costing. So activity-based costing is basically, it says that rather than plotting or allocating the whole fixed cost on the products in maybe an evenly kind of an arrangement, which was the traditional. So whereby if we are talking about the fixed cost, these are basically, how are you allocating these costs back to the product. So like in the traditional unit, so let us suppose if there is a fixed cost, to give an example, that fixed cost can be related to maybe any machinery as well. like in this example, they are talking about the fixed cost per month for a particular machine. So if this is a 20 lakh rupees of a cost, then in the traditional methods, what they will do, they will calculate the total net profit, gross profit, and then they will reduce the fixed cost from that profit to come out to the net profit. Now the point is when we are talking about the activity cost based costing, we don't do the overall allocation of the cost while we allocate this particular cost at our activity level. So if this machine's 20 lakh rupees of the fixed cost is there, we allocate it to further, let us suppose if there is a batch that is being processed or there are any setups that are being created. So if this fixed cost is there to run 500 batches, then we will calculate what is the per batch cost. So that as in management, we know that if we are reducing the batches from this particular limit, then the costing will be higher. Per batch costing will be higher. And if we can somehow increase the number of the batches, then the normal batch size, then the costing per batch will be reduced. And this actually gives the management some level of insights to select the prices and to come up and compete with the outside world. That's why the ABC costing is known as the modern costing, while the traditional costing is known as the traditional costing. So during the CVP analysis, so this table actually shows us both traditional and the activity-based costing for the children division of Cycles India Limited. So they are saying that the monthly demand and the production for the children's cycle is 20,000. This will remain. So because this traditional and activity based, this is a way to allocate fixed cost on the products, right? So in the cases of traditional or activity based costing, at least the selling price, variable cost, demand, everything will remain same. It is just the costing which will have different kind of ways to calculate. So you see monthly demand and production. So they are saying like 20,000, 20,000 fixed for both. Selling price is 16,000. Variable cost per unit is same, 15,000. Like in these two methods, there is no difference, absolutely no difference other than costing. We need to talk about the cost of fixed cost, how the allocation is done. While on the one side, in the traditional method, they are saying that 20 lakh rupees is the cost, total per month cost, fixed cost. They are allocating it on all the cycles that are manufactured. On the other side, if we are talking about the activity-based costing, we are saying that this 20 lakh rupees is the cost that will remain there, but out of this 20 lakh, 16 lakhs is the fix, while the 4 lakh rupees of a cost, it will depend on the setups. So the company is saying that they have around 800 setups and the cost per setup is 500. So this is the cost that they are allocating on the setup. So as a management, I know if I'll be manufacturing any setups uh, below 800 total number of setups, then my costing per setup will be higher. So the cycles that I'm making in that setup, in the batch, the costing of those cycles will be higher. While if I'm somehow able to increase this particular 800 cycles to let us suppose 1000, the cost 4 lakh will remain same. Okay, so that's how I mean when we talk about a particular activity and we calculate a costing based on that activity, that is known as activity based costing. But when we are allocating the whole cost on the products, then it is known as the traditional way of cost allocation. Studying more about it, it says like fixed cost of 20 lakh per month under traditional CVP analysis are those that do not vary with respect to volume. So they are irrespective of the volume. Obviously, if they will, they will be different depending on the volume, that it will be either a variable cost or semi-variable or semi-fixed cost. That's a different cost. Following an activity-based costing, fixed costs that do not vary per volume or any other cost driver has been identified to be 16 lakh rupees. So out of 20 lakhs, 16 lakhs is a fixed. The study revealed a milling machine is used to cut metal into steer support. Production of these steer support takes place in batches of 25 units. So they are doing it as a batch processing. So 25 units, the batch of 25 unit is there, and this particular machine is used to cut the metal. Now, once a batch for children's cycle is finished, the next batch would be that for the adult cycle. So they are manufacturing the cycles into the batches. One batch of children's cycle, the next batch will be for the adult cycle. Therefore, after each batch, there would be a setup change. If 20,000 children's cycle have to be produced, so let us suppose if they are thinking about the 20,000 as the monthly target, then if they are manufacturing 20,000 children's cycle, then the number of setups required will be 20,000 divided by 25. Remember, because these 25 units is something that they are able to process in one batch. So they will have 800 setups, 20,000 divided by 25. Each setup will cost 500, comprising of metal cost like change of oil, jig, etc. So this is 500 rupees is actually per setup cost. This cost was previously pooled together with fixed cost under traditional CVT analysis. So that's the same thing we are discussing, that this 4 lakh is something which is dependent on setups. But in the traditional, they don't care about the setups and all. This is not dependent on activity, while setup is an activity. Going ahead, the plant manager would like to keep the number of setups minimum since they reduce the capacity of the machine. So if they will have the setups minimum, so like you see, there is a 500 rupees per setup cost. So they are saying if we want to reduce this per setup cost, this cost will reduce, right? So let us suppose if the batch instead of 225, if they will increase to 100, we'll still have to make 20,000 cycles only. So if I can make a batch of 100 cycles, then the setups will be required only 200. So this is what the plant manager is thinking. That if we can reduce the batch sizes, then the cost will reduce and probably they can utilize the machine in a better manner. So now the plant manager would like to keep the number of setups minimum since they reduce the capacity of the machine. Suppose at any time the milling machine can be used to produce batches of either adult or children's cycle. He proposes to increase the batch size of children's stair support to 100 units. Okay, so that's the same thing. So he's thinking from 25 units, let's increase this to 100 units in one batch. The number of setups will reduce from 800, which is the current. So they need 800 setups. This will be reduced to 200 setups. Due to larger batch production, additional inventory storage area that would be required to store that will cost the company 1 lakh rupees per month extra. Now, what is this? You see, if I am processing, if I am manufacturing the cycles in the batch of 25, then these 25 batches that are being manufactured, these 25 cycles will take lesser space. Okay, but if I'll increase the batch size, then the production capacity, I mean, the production line has to be refined accordingly, and we will be able to produce 100 cycles in a batch. So we need more space. The storage will increase. So they are saying if we will increase the batch size, right, then the number of setups will decrease to 200, which means my overall costing 500 per setup, which was earlier for 800 setups. Now this will reduce to for 200 setups. So I will save some amount here. But while I'm saving here, since the batch has increased from 25 cycles to 100 cycles, my storage cost will increase. So they are saying we will save some setup cost here, but the storage cost will increase. And the storage cost that will increase is 1 lakh rupees per month. The annual manufacturing capacity at CIL is currently 10 lakh cycles. So they can manufacture around 10 lakh cycles. The demand for cycle has been increasing in India. Hence, the management wants to increase the annual manufacturing capacity to 18 lakh cycles. So they have a capacity of 10 lakhs. They want to increase it by 80%, which is like 18 lakh cycles. Due to increased production requirement, CIL bought additional machinery for the production line. So they have actually purchased more machinery. I told you if you are going to increase the batch processing size, more machineries will also be required, right? So they bought more machineries and the overall capacity is also increasing. So machinery requirement will be there for production line. So all assets were purchased by account pay check. Below are the details of the plant and machinery. So they are saying there is an opening WDB, okay, written down value of the plant machinery on 1st April 23. It was 10 crores. So in my books on 23rd, beginning of 23-24, we have 10 crore rupees of plant and machinery already there. Written down value as on 31st March 23 after reducing depreciation for the CY 22-23. So this is the net block basically. So they are trying to say that this is WDV is the net block. This is not the gross block. You know, when you are passing the entries or you are recording the depreciation, there are two ways which you theoretically read in your book. One is basically whereby you are reducing directly depreciation from the asset. It means you are reducing the asset amount. While in the other side, you are not reducing the asset amount, so your gross block remains same. And your entry, instead of hitting the assets, it is hitting the accumulated depreciation. So the question is clarifying that this 10 crore is actually not a gross block, but this is a net block. This is after the depreciation. Because the depreciation in the WDB will be on the net block. It will never be on a gross block. If you'll do the depreciation calculation on the gross block, then it will be not WDB. It will become SLM, right? Then we have new plant and machinery purchased and put to use. So there are new machinery which is purchased and put to use. That is on 30th of June, which is of 5 crore rupees. This is the new machinery they have purchased and put to use. There is another set of machinery that they have purchased and they are putting to use, and the date is 31st December. You see, there is a concept of 180 days in the taxation as well. And then we need to see any asset that is purchased and put to use for more than 180 days, 100% depreciation will be allowed. But if it is less than 180 days, then 50% of the depreciation rate will be allowed. But since it's a manufacturing unit, we will have some advantage of additional depreciation as well. We will discuss and see this in the next part. Due to increased production requirement, now since the company has increased the production, the need for storage space both for raw material and finished goods has increased manifold, obviously. So the storage space will also increase, right? Now you see the storage for the product, the cycles which will be produced, this is already increased by 1 lakh rupees per month just because we have changed the process size, batch size. But if you are having increase in the batch size as well, then the raw material will also be instantly required. So the storage cost for the raw material will also increase. So they are saying due to the increased production requirement, the need for storage space both for raw material and finished goods have increased manifold. Storage cost at CIL's factory site that manufactures cycle is very expensive. Okay, so what happens actually, you know, this factory site which is there, if they want to increase the storage cost over there, if they want to increase the storage capacity over there, the costing related to that capacity is higher. Because what happens generally, we have these manufacturing units or factories set up in industrial areas. Industrial areas are expensive. If you are trying to have more storage space in these areas, that will be definitely costly. That will be expensive. So hence the management wants to consider the option of implementing an effective just-in-time system for material procurement and production in order to reduce on the need of additional storage area. Now what is this just-in-time? As the name suggests, so we call it JIT, right, in the inventory management. Just-in-time says that we will have inventory, we will purchase inventory, we will allocate or we will transfer inventory to the production only when it is required. It means there is no need to kind of, you know, store the inventory. Whenever the time will be there, whenever the need of the inventory will be there, we will provide that inventory just in time. So let us suppose we have another storage space little far away from the industrial area that we just discussed about, and then from there, inventory will be coming to the factory to the production only on need basis. So whenever the need is there, whenever the need is there, the production, the batch is getting processed, we will issue it just in time. So just in time says, but you see, as the name suggests, if you want the inventory to be on just in time, it means the production expectations, estimation, estimated products, production, the normal and abnormal wastage, everything, all this data should be super accurate. If you don't have this kind of data accurately available, then this JIT system may not be able to work, right? Because You see, if I don't know how much production is required today, how many units are to be produced, how many batches will be processed, then just in time will not work because I don't have any inventory of raw material, etc., which is already stored in my factory. I have to order it just in time when I need it, and it will take some time. So having a production estimation or expectation matching to the reality on ground is a key for this kind of a system to work. On the need of additional, under the GIT, the material will be delivered directly to the machine on the shop floor. You see, this is what I'm saying. Directly to the production, the material will be delivered. Also, GIT is being a pull system initiated by the customers. Once the cycle is manufactured, it will be sent out for delivery to the customer immediately. So it means they are not storing. So they are like if a wholesaler is there, if a distributor is there, they are asking, let us suppose for 100 cycles. So they are manufacturing it and clubbing all the demand from all these people, and then they are processing or producing only those number of bicycles which can immediately be sold out to those customers. During the meeting, as the management accountant, you pointed out that the GIT system needs to be sufficiently supported by an effective back flushing system that will account for the component materials used in the production process. So, as an accountant, you are saying that this JIT system, if you really want to, let us suppose, produce the volume, or you want to kind of come up with an exact or adequate cost, the back flushing system should be working in this case. Now, what is the back flushing system? So, back flushing system says that the cost of the batch will only be calculated once the production is complete. So, it is not like I am maintaining the inventory on the real time basis. I know my standard costing. I know how much costing per batch will be there, how much raw material will be used, and all these things. So backflushing system says that once the batch will be processed, I have the standard costing and I'll do the quick calculation that what is the total cost of the inventory or the raw material that has been consumed. Okay. Instead of doing a real-time recording. So as an accountant, you are suggesting since you are using just in time, the management is using now just in time, it will be better instead of making a note of every time the material is coming and all these things. They will be, rather than standing at the input side, they will be standing at the output side, and then they'll be recording whatever the production is complete. They can do the immediate calculation of the costing around it. This is known as back flushing system. Given the large production volumes and the fast turnaround time required under GIT, back flushing system is the ideal solution to account for components. You see, so large production and then the fast turnaround time. If we will do the regular inventory in the traditional manner, I mean, it will take time. Then I need to kind of issue to the production. I need to have a proper record around it. We need to make the purchase requisitions. We need to make the purchase orders if required, and against those purchase requisitions, will be sending the inventory to the manufacturing. So issue notes, material issue notes will be there. I mean, there will be too much recording, too many things will be there. But if are doing the back flushing system, we'll look at the output. We will see this is the output. This is the standard inventory requirement. So this will be the costing of this particular batch. Okay, it will save a lot of time. But if that is happening, the accuracy in the production estimates, the accuracy with the data of all this standard costing of particular batch is very important. Okay. The next part of the question or case study says CIL has recently decided to start selling cycles to professional cyclists within India. So now they are talking about another segment. So they were discussing about children and adult initially. They were more focused on the children bicycle. Now they are saying we are talking about the professional cyclists, which is the adult part. Now CIL has recently decided to start selling cycles to the professional cyclists within India. International exposure and increased availability of facilities has improved career prospects for professional cyclists. So they are saying now people are, I mean, they are more inclined towards the cyclist as a sports as a profession. So there is a demand which is getting increased for the professional cyclists. So they are saying that the international exposure and the increased availability of the facility, they have improved the career prospects for professional cyclists. Yet at present, this market segment is at the nascent stage. The company is also poised into the segment for the first time. So this is not a regular segment for the company. So maybe the adult cycles was a regular kind of a segment, but in that they are creating now a professional cycle, which is a new segment for the company as well. The company is also falling into the segment for the first time. CIL has opened a small dealership shop in Mumbai specifically to sell these high value professional cycles. So there is a CIL opened a small dealership so that they can sell the professional bicycles. On March 31st, 2024, it imported its first batch of 100 professional cycles from a company in France. Now, since they are new into this particular segment, so what are they doing? They are importing from France to see the quality, how they are building and all those things. And maybe in a couple of months or years down the line, the company will start replicating or start learning from the technology that is used in these professional cycles and will start manufacturing the professional cycles on their own. But for this particular batch that they have purchased for 100 professional cycles, the details of the expenses incurred at the dealership in Mumbai are given below. So these are the expenses that they have incurred. Cost of the purchases, right? So this is the supplier invoice, 50 lakh rupees. Handling cost relating to imports, 6 lakh. Salaries of accounting staff at the dealership who is recording this sale and all, 5 lakh. Sales commission paid to sales agents. Okay, so commission is also something that is an expense they have incurred. After sales warranty cost, 4 lakh rupees is the expense. Import duties, freight expenses, insurance of purchases, and brokerage commission paid to identifying agents. So this is again a kind of a commission. Okay, perfect. So these are the expenses for this particular sale. So uh, the 100 professional cycles are held in the stock as on 31st March. So all of them have been held in the stock, which is the end of the financial year. The current market price of these cycles is 64,000 per unit. Okay. So they are saying there is so much of expenditures that have happened. If you see 50, 56, 61, 69, 73, and then 5, 78, and 80 lakhs, right? So close to 80 lakhs is the expense that they have incurred to have 100 cycles. It means they are incurring around 80,000 rupees per cycle, the costing. If you'll see from a regular kind of an accounting perspective, not from the cost management accounting, but they are saying that these cycles, the market price for these cycles is 64,000 per unit. Now you see, they have incurred around 80,000, but we need to see that what are the costs which will definitely be considered as the cost of this particular cycle, or what are the costs which are not considered as the cost of this cycle. But market price is 64,000 only. KIL has also a firm sales contract with a smaller cycle dealership for 30 cycles. So the market price of these cycles is 64,000, but they somehow have a contract with another small cycle dealership that they will be able to sell these 30 cycles in 65,000 rupees per unit, which cannot be settled yet. Okay, estimated incremental selling cost is 2,000 per unit for all cycles. Now they are saying that to sell these cycles, okay, they will spend 2,000 rupees again further. So like for this 64,000 and for this 65,000 rupees, they will incur 2,000 rupees in addition to the cost. So whatever the cost is there, they will incur 2,000 more to sell it at 65 or 64,000 rupees. This will be helpful in calculating the net realizable value. So if you are aware that we need to value the stock at cost or NRV, whichever is lower. Now in this case, cost is something which is given in the question, but there are a lot of costs which shouldn't be a part of the inventory, part of the cost. So the any cost which can be directly associated with the raw material or the inventory or the goods that we are talking here, it can only be considered as a cost. Any indirect cost that is there shouldn't be a part of the cost. And then what is NRV, net realizable value? I have in my experience seen a lot of people getting confused about the NRV with the market price, or what is the market price. So when you are practically dealing with this NRV kind of a thing, you need to be 100% clear about the difference between the cost and the NRV. Cost is actually the cost which is there to make the goods available in the present till the present condition, directly allocated cost. So that is the total cost of that particular inventory. When we are talking about NRV, then we are talking about if we will end up selling these inventory items from here only, in the same state in which they are available. So let us suppose I have manufactured some goods and those goods are lying in my godown. Now these goods are lying in my godown and then they are lying, let us suppose, at 100 rupees of a cost. The market value of these products, these particular products, they are 150 rupees. So the inventory cost that I have incurred is 100 rupees, but I will be able to sell them in the market for 150 rupees. Then 150 rupees is the selling price. Okay, 100 is the cost. What is the NRV? NRV is basically how much additional expenses I have to make, which is generally my sales expenses. How many additional expenses I need to make to sell these inventories. So let us suppose even though I can sell these inventory in 150 rupees, but I cannot sell them in their present condition. So there is a probability that I'll need to transfer them to, let us suppose, one of my showroom where the showroom related costs are there, salesman's cost is there, rent is there, electricity is there, or some advertisement or marketing expenses are there. So these are the additional set of expenses that I need to incur to sell my product. So NRV means what if I'll sell these products in their present state only without any additional sales expenditure. So let us suppose per unit cost of additional sales expenditure to sell these products is 30 rupees. So in that case, if 150 rupees is my selling price and 30 rupees is the additional expenses, then the NRV in this particular situation will be 150 minus 30 rupees, which is 120 rupees. Okay, so in the given situation, the cost will become 100, the NRV will become 120, and market selling price will become 150. And in this given situation, if we need to value the inventory should be valued at the NRV or cost, whichever is lower. If you think there is no additional expenses, selling expenses, and you can sell the products in the current state only from directly where the position where the inventory is lying, then in that case NRV and market price can be same because there are no additional cost that selling cost etc. that you are expecting to incur. So in the given situation, there are around 80 lakh rupees of a cost that we have incurred. But is this the real cost which can be allocated on the inventory? We will see because there are like if somebody is sitting in the salary as an accounting staff and all, this is not related to the inventory. The generally the sales expenses etc. They are also not related to the inventory. Okay, so we cannot just say like this all is the cost of my production that can be like that cannot go and become a part of the cost of goods sold. It can be settled maybe somewhere in the P&L. This is the difference. Okay, so we are able to sell, the market price is 64 and 65, but 2000 is the incremental cost. The manager of the dealership of imported cycle, so the manager who is there for the dealership is of the opinion that at a selling price of 64,000 per imported cycle, which is there, CIA will be unable to earn any profit margin at all. So they are thinking we will not be able to make any profit margin. The price is too low. The same is true even with a firm order of 230 cycles with sale price of 65. So they are, the manager is thinking actually that we are not able to make any profits on 64,000 or 65,000 because the costing is there. A higher cost is there. She wishes to increase the selling price to 85,000 per cycle. So she is saying, let's increase it to 85,000 because you can apparently see she might be of an opinion that 80,000 is the cost per cycle that they are incurring. So she is suggesting let's increase the price from 65,000 to 85,000 per cycle. Her annual performance is based on the profits that this dealership venture generates. Now you see, there is a performance appraisal process. When I joined my first corporate, I used to think how they are managing resources, how the resources are being managed, why everyone is working without having kind of a close eye or doing a micromanagement, how management is able to handle their resources without doing a micromanagement. While my articleship was from a small firm, and I was always able to compare a small firm's way of working and a big four's way of working. And I was fortunate enough to find the differences. That what is the difference? If we are talking about the resource management, what is the difference? How both the firms, a small firm and a big four, is managing their resources. And I can recall actually, like in the first week of my joining of a big four, when my HR and my manager came to me and then they asked me to do some goal setting. Okay, goal setting. I was kind of very new to this particular performance appraisal process, and I ended up asking the HR that if she can explain what is exactly this performance evaluation or performance appraisal process. And then she told me that at the beginning of the year, you need to set your goals at a different sub departments that the firm is having. So let us suppose we are talking about the audit. There are various sub departments in the audit. We have clients and markets. We have quality. We have profitability. We have people and partner. There are a lot of sub departments. Like clients and market is taking care of how the new clients will be onboarded or how the existing clients potential will be unleashed. How to identify the opportunities. So quality, the people and partner department will ensure that whatever work the clients and market is getting into the firm, the people and partner will ensure that they have adequate resources. The headcount is there to deliver that work. Then we have a quality department. So quality department's responsibility will be to ensure that the headcount which is present with the company, that headcount is adequately trained. They are able to deliver the quality and so on. I mean, we have admin and IT, we have human resources as a separate department, we have finance and reporting, we have profitability and operations. Each of the sub department has their own role, and then they jointly create the division, the department of, let us suppose, audit, or they create a service line. They all are working together to run a service line. This is how they work. So in that case, if somebody is joining, let us suppose if a manager is joining in the big four, they will be given some parameters, goals we call them. Like for clients in markets, let us suppose somebody is given, a manager is given a goal that you need to bring business of 50 lakh INR, new business or from an existing clients. This is how it is. So there is an expectation setting. Or if they will be given, like if we are talking about the utilization, your available hours should be utilized, let us suppose 70% on the clients. So this is the goal that is being given by the firm. Or maybe they have another goal of quality, like the escalations will not be there, okay, from the client. So those kind of goals are there. And on the basis of that expectation that we set in the beginning of the year, the management is appraising the resources after the year end. So if we mention that a manager is supposed to or expected to bring a business of 50 lakh, and if it is a part of their goals, at the year end, we will see how many managers are able to bring the business of 50 lakh. If you are able to bring the business, then you are meeting expectation. If you are not able to, then you are not meeting expectation. If you are meeting expectation, there will be increments, bonuses, promotions. If you are not able to meet, then the bonus, increment, and promotion will not be there, and there is a high probability you may be put on a improvement plan as well, right? And later on, the firm has all the rights to ask you to resign or to ask you to leave the organization. This is how it is, I mean. So when we're talking about the annual performance, this is what we are talking here. That the manager, why the manager is pushing that the price should increase from 64,000 to 85,000, because her performance, so the goals that have been given, that your bonus, her promotions, etc., they all will be based on what? On the profits that the dealership will generate. So the management has told this particular manager that your promotion or your performance will be based on the profit. But if at 64 and 65,000, the company or the division is not able to make any profits, then that will impact her performance appraisals as well. Her promotion may be delayed, her bonus may be shrink, her increment may be smaller, all those things. So she is worried. So she is suggesting, let's increase the price of cycles from 64 to 85,000 so that I can clearly have a profit. 80,000 is the total cost, irrespective it is the cost related to inventory or cost which will be transferred to P&L account. But she is like, at the end of the day, I'll be able to make the net profit. But whether they will be able to do it or not, it is also dependent on the market, on the competition. If the competition is existing, there are people who are selling this particular product at lower prices than 85,000, then it will be very difficult to increase the prices. If there is no apparent kind of competition, or the cycles that we are selling, they are unique in design, in performance, and anything, it means the customer cannot compare them. Even the competition may be there, that I have a competition, and then they are selling their bicycles. But the point is, the cycles that I am introducing, launching in the market, I mean, a clear-cut competition is not identifiable. It means the same kind of a cycle, same look and feel, the cycle is not available with my competitors as well. In that case, since customers cannot compare them, then the customers will agree that this 85,000 can be a good price, considering the level of value that the cycle is able to generate. How much, what is the level of customer satisfaction that they're able to do. Her annual performance, okay. Hence, she is very insistent on increasing the selling price of the important cycle. I think now this is clear. So this is the whole case study. Now, when we have gone through the case study, you see what is happening in the whole of the case study. Initially, we have been given a table whereby a traditional and the activity-based costing difference is there. That 20,000 is the requirement, but this 20 lakh earlier in the traditional this was a fixed cost. In the activity-based costing, we are able to identify that 16 lakh is the costing, and the rest 4 lakh rupees is basically setups and the cost per setup. Okay. Now, this 20,000 is manufactured in 25 units, and that's why there are 800 setups. Per setup is 500 rupees. So to reduce this cost of 4 lakhs, right, the manager is suggesting that we should increase the units from 25 to 100, which means the pack size will change to 200. But because the batch is increased, now the storage cost is also increased. So storage cost of 1 lakh rupees per month extra is there. But this is the storage of the cycles. To avoid this storage cost, the manager again put his brain and came out with a solution that we need to have a JIT system, just in time. So we will not store anything around and we will order in time, just in time. And again, we will be selling or we will be producing the batches in commensurating with the orders that we are going to receive from the market, from the wholesalers, retailers, from the other distributors. So that was one part. The other part is whereby to increase the capacity, right? They have purchased two machineries during the year. One is put to use for more than 180 days. The other one is put to use for less than 180 days. And then the opening WDV of the block of plant and machinery is also available there, which was 10 crores. This 10 crore is the net block. Okay. Because this is after the depreciation for the year 22-23. This is another thing. After JIT, we discussed about just-in-time inventory and backflash system, whereby this can be, I mean, the costing of the in this particular cost can only be calculated, should be calculated on the basis of the batches that we are processing, rather than recording it at every step. The other part is basically that they are thinking they should enter into the professional cyclist kind of a market, whereby they have imported 100 cycles. Out of this 100, they have 30 cycles kind of a contract which is already there. The price for this 30 cycle will be 65,000, and the current market price for the remaining cycles is 64,000. But to reach to 64 or 65,000, they need to spend 2,000 rupees per cycle in addition to the costing that is there. So they have a lot of costings, and we need to also see that what is the costing that is allowed to be taken as to the inventory level, and what are the costings which are not allowed to be taken at the inventory level. Now, the last portion was basically whereby the manager is of an opinion that the costing should be increased to 85,000 per cycle, because her performance is dependent on the profits that the dealership will be generating. Great. So this is the whole case study. We can move to the questions. As discussed, I mean, you know how the IBS case studies they work. They will have some multiple choice questions, and then after the multiple choice questions, there will be some descriptive questions. So this case study is also having some multiple choice questions, five multiple choice questions, and then we have around two descriptive questions. Two descriptive questions, but each question have three subsets, three subsections. We'll go one by one and we'll try to understand that what is the solution, what is the answer for them. So like first question is, given the information about CIL's plant and machinery, the total amount of depreciation that can be claimed as per the Income Tax Act 1961 for the assessment year 24-25. The company does not opt for section 115BA and AA and BAB. Right? And remember that this is a open book exam. So if in case you have any kind of question, you can reach out to the right material as well. But in the question, if we'll talk about what is the total appreciation, then this is the part of the question that we need to focus upon. The opening WDV, we have 10 crores. On this 10 crore, we will have the full year's appreciation. On this 5 crore, since it is for one more than 180 has put to use, we can have depreciation, full depreciation on this. But this is put to use for less than 180 days. So we need to have 50% of the depreciation on this. Now, since this is a new plant and machinery that is being purchased by the company, so there will be additional depreciation also available in the first year. When I think in the previous session also I mentioned that additional depreciation simply means that there was an expense that you could have taken in the upcoming years. By providing you additional depreciation, it is just the time difference, the advantage of time difference. So there was an expense that the company would have, let us suppose, charged to its P&L account over the period of time, over the useful life of the asset. But the government is incentivizing how they are giving this as an incentive that that expense that you will be spreading across in the future is something you can put some additional part in your P&L for this year. And if that additional depreciation will be there in my P&L, my profits will reduce. It means my government will be giving me 30% or whatever my tax rate is as the return or in the current year. So let us suppose this would have impacted my next year's profits and then respective tax calculations, whatever the total amount of tax that I was supposed to deposit in the next year, that is something is actually being given as a benefit in the current year as well. So I have reduced my tax liabilities in the current year rather than doing it in the next year. It means there is a timing difference. The benefit of tax saving, which I would have taken in the upcoming years, maybe throughout the useful life, I can claim in this year. So the answer is basically 4 crore 12 lakhs. How they have calculated in the same manner which I just mentioned, that for the depreciation, normal depreciation, it will be on the 15 crores. That is the opening WDV of plant and machinery 10 crores, and then the 5 crore rupees of an asset which is put to use for more than 180 days. So total depreciation will be 10 plus 5 crores on 15%. The answer is 2 crore 25 lakhs. But we have another asset which is put to use for less than 180 days, on which we can have 50% of the eligible depreciation in this year. Again, this is just a timing difference. Remember, depreciation is only a timing difference. And since it is a timing difference, that's why, okay, we need to calculate the deferred tax asset and deferred tax liability in relation to this in the books of account, right? Because like, even if it is available in the income tax, it will not be available in the company's tax books of accounts, right? So over here, I am actually reducing my profits, while in the company's books of account, the profit will be higher, and that's why a DTA or DTL calculation will happen. Okay, so but along with this, what is happening? This is the normal depreciation that is allowed, but there will be an additional depreciation as well, which is the 20% on 5 crores full year, and 20% 50% because this is less than 180 days. But this remaining additional 50% can be available in the next year, next assessment year. So this is the additional depreciation 1.5 CR and this 2.62 CR, so 4.12 CR is the total depreciation which can be claimed, which is the option B. Okay. Here is a note as well which says like as per the third provision, the balance additional depreciation being 50 lakhs on the second machinery, right? That's a benefit basically. So on the second machinery, it is not like if you have purchased in the current year and then only 50% depreciation was claimed. I can't claim the remaining additional depreciation as the benefit in the next year. The government allows it and then we can claim it in the next year as well. Okay. Moving to the second question. It says like determine in which of the following cases should labor cost not be factored into the cost of setup. Okay. So they are saying the labor cost should not be factored in the cost of setup. In which case? Remember. So labor cost should be a part of it, but like if my labor is sitting idle or I have idle capacity available with my company, then that idle capacity should not be put as the additional cost because I generally calculate what will be my incremental cost. Any idle capacity that I have, it will be not considered as part of my cost of the setup. So the first part is saying cost of using temporary labor hired for particular setup. You see, if I'm creating a setup and I'm hiring resources for that, it is not the utilization of idle capacity. It is the incremental cost because of the setup. So it will be a part of the cost of setup. Second option says that cost of outsourcing setup activities. So if I am setting up, so rather than hiring a labor, I'm not hiring a labor, but let us suppose I am giving this, the work of this labor, I am outsourcing it to a third party. Okay, maybe a job work or something sort of. If that is also happening, at least this is also an incremental cost happening because of my setup. So that will also be a part of the labor cost. Third is cost of using permanent labor who are otherwise idle. So I have a team of permanent laborers who are sitting in my factory and they have some idle capacity. It means if let us suppose they could produce 100 cycles in a day, but they are only producing let us suppose 50 cycles. So they are sitting at 50% idle capacity. So if in that case, if I'm getting anything extra or the setup cost is there, that idle cost shouldn't be there. Otherwise, I would have ended up paying them by default. So this is not an incremental cost because of the cost of setup. D says if additional labor supplies are unavailable in the short term and where no further overtime working is possible, cost of using permanent labor who are engaged in production process. So they are saying if the labor is permanent but they are engaged with the production process already. So what is happening? That is the case. This is the case of the opportunity cost. If I am taking my labor out from there, it means either the production is getting impacted on the product line where these labors were working, or if the production is not getting impacted, it means I have made some alternate arrangement by hiring contractual laborers or by giving that work to the outsourcing part. It means that will become an incremental cost. So what cannot be an incremental cost or should not be an incremental cost is that the team I have is sitting idle and then I'm using them to produce or to manufacture this. So the answer is C, that the cost of using permanent labor who are otherwise idle. The cost of permanent labor used for setup who are otherwise idle would not be included in setup cost since the salaries paid to them have to be incurred anyway. It is a sunk cost. I mean, it is a cost that will be there anyhow, whether you use them or you don't use them. The cost of temporary labor hired for particular setup or cost of outsourcing of the setup activity would be included because this is an incremental cost as these are expenses incurred for the purpose of setup. Where permanent labor is used for setup who are otherwise fully engaged in the production process and additional labor supplies are unavailable in the short term and where no further overtime working is possible, The opportunity cost, this is what I told you, right? This is the opportunity cost actually. I lost the contribution from the product or product line where this labor was working. Needs to be considered along with hourly labor rate. Okay. So this will become the additional costing. Third question says that which of the following is not a prerequisite for an effective GIT system? So if you want to use a GIT system, what is not a prerequisite? Remember what is GIT system? Just in time. It means I can issue the inventory, raw material, etc. as and when it is needed. So there is no storage required. Now, if you want to issue the or let us suppose you want to produce certain cycles. You see, if there will be a varying demand pattern, which is the first option. If this is a varying demand pattern, I mean, I don't know how much the product will be required, how much project is needed, right? So how much production is needed? I can't estimate. And if I can't estimate, just in time will not work. Why it will not work? Because then I have to kind of immediately see that what is the total GIT that is needed. Okay. So if I need to see how much inventory I need to allocate to the production, it will be very difficult. It is not possible, right? Until or unless I have a clear cut demand estimation. So I know that in this month, this particular distributor will be needing this cycle, this cycle, that wholesaler will be needing that much of cycle. So if I have a fixed kind of production estimates, then only this JIT will work. The lesser setup time, if you want the setup time to be lesser, I mean, in that case, it will also be very difficult. Total quality management. You're looking for total quality management. That's also kind of challenge. Or multi-skilled labor force. So which of the following is not a prerequisite? Prerequisite means that you will need to have this particular thing. Over here, this all is required as a prerequisite, right? The setup time is lesser because you will be giving the JIT in time. Quality management is something that we can obviously ensure. Multi-skilled labor force is also something which is a prerequisite. Because you see, this will be like there are multiple labors which are involved, and then we have to give the inventory as and when it is required. So the skill is required. The labor has to be skilled labor, multi-skilled labor. Which one inventory is immediately coming, how to handle that inventory, what is the machine where the inventory will be put as an input, and all these things, this is required. The quality management is something which is very important. If I am sending the inventory as and when it is required in the JIT system, it will be very difficult to kind of fulfill if in case I am sending the quality which is not right. So basically, this varying demand pattern is something which is not possible. It is not a prerequisite. Okay. Fourth is which of the following is not a problem of using back flushing in the GIT? Remember, not a problem. Okay. So if you want to do back flushing in the GIT, remember in the back flushing of GIT, it is basically having a standard costing set for a particular batch, and we will calculate the total costing when the batch is complete, the production is finalized. So they are saying that what is not a problem, it's not like a problem. What is not a problem? Okay. The production reporting has to be accurate. You see, backflashing is only possible when the production reporting is accurate. Because if the production reporting is haywire, then you cannot do a backflashing in the GIT. I mean, the whole of the batch that you are trying to charge the costing. If the production reporting is inaccurate, you will end up charging the wrong standard costing because you are not recording every unit that you are sending to the production. Instead, you are doing a batch processing at the end of the production itself. So the production reporting has to be accurate, there is no doubt. The scrap reporting has to be accurate. Yes, it has to be there. The scrap reporting, because it will impact my JIT costing. So if the scrap is something that I'm not able to get the real idea around, it will be difficult to measure the costing of the backflashing. Unless the software allows picking and backflashing systems to coexist, lot tracing is not possible, right? So this is also very important. So I mean, what is not a problem? So this is a problem that we need the exact reporting. This is a problem we need the scraps reporting adequately. This is a problem unless the software is not allowing picking and the backfishing systems to coexist. Tracing will be a problem. The backflashing requires no data entry of any kind until a finished product is completed. This is what I'm saying. Backflashing is actually something that you can do the costing after the production. It means in one go you can record all the costing. So actually this is not a problem. This is a benefit of having the JIT system. So in the fourth, the answer is backflushing requires no data entry of any kind until a finished product is completed. Fifth is saying which of the following factors will make the customer more sensitive towards the price of the professional imported cycle. Now you see, the manager is thinking that the price should increase from 65,000 to 85,000. Okay. So if the manager is thinking about this, what is out of them that will impact the customer or it will make the customer more sensitive towards the price of the professional imported cycle. So we need to think from that perspective that as a customer, what is that will make you more sensitive towards the price? Higher perceived quality of the cycle. So if you get a cycle or you are looking at a cycle and then you are thinking the quality of this cycle is really amazing. It's highly kind of perceived. Then as a customer we will think yes the price can be. I mean if they are charging 85,000 rupees it's absolutely fine because the quality is so upgraded, so great. Second is practical difficulties in comparison of the imported professional cycles with any alternatives available domestically due to the lack of awareness. As a customer, if I cannot compare this price which I am offering in the open market in 85,000 rupees, then I'll not be price sensitive. I'll not be sensitive towards the price because I cannot come back to the company saying that listen, in your competition, the other guy is selling this cycle in 65,000 while you are trying to sell it in 85,000 because I don't have a competitive, I don't have a competition or I don't have those cycles with me. Third says that the imported professional cycles being unique can give users recognition among peers. So if I'm purchasing these bicycles and then I'm getting some unique recognition, so my bicycle is different, it is unique. So when I'm taking it out in my peer group, I'm getting that recognition that he has a good imported cycle. So when people are talking about it, I mean, they know when they are talking and then the peer recognition is there, it means the cycle would be costly only, right? So in that case also, so I mean, the initial three will not make me more price sensitive. I mean, if the quality is really high, if the product is imported and I cannot compare it with any of the products around in my domestic market, I don't know whether 85,000 is the right price or 65,000 is the right price. In the same manner, if my cycle that I'm purchasing is giving me recognition in my peer group, also I'm really happy. I can pay higher price. The fourth is basically high proportion of expenditure, product cost to the customer income. Now you see, I am actually increasing the product cost or whatever cost I'm increasing. Like let us suppose the salaries of my accounting staff, which was given over there, and I'm considering that this should be charged from the customer, and I'm including this as an inventory cost. So it means what is happening? I am increasing my costing, but the cycle is not giving any kind of value addition to the customer. Customer can't relate this additional expenditure, the salary of accountant, to the higher quality or to the imported cycles and all those things. In that case, this unnecessary expenditure that I am doing or posting, my competition will not be doing that, right? So if I'm putting some extra charge on my cycles, which my competitors are not doing, that will make me more price sensitive. As a customer, I'll go back to the company and I'll be like, you are asking a price which is not equivalent to the quality of the cycle that you are providing. So this will become very difficult. So for the fifth, the answer is D. High proportion of the expenditure product cost to the customer income. Where the expenditure on account of the purchasing the product is high, in proportion to the customer income, the customer will be more sensitive towards the price of a product. Simple. If customer cannot relate to this quality or probably recognition or the market competition, then we will be very much concerned about the price. Now coming back to the descriptive question. So we have two descriptive questions, but we have three subsets of each question. So we're talking like the first question is six number. The first subset of this says like find the break-even point per month and profit per month under the traditional CVP method and the activity-based costing method when the batch size of the manufacturing children's steer support is 25 units. So they are saying if the batch size is 25, okay, then how much is the cost difference? You see, if you can recall the table, which was the first table, over there it was mentioned that the batch set is 800 because of 25 as a cycles. And if we are doing it, 500 is the additional cost. So 800 and 500, if we multiply them, this is 4 lakh. So the fixed cost is not getting changed. 20 lakh to 20 lakh and the rest of the variable cost will remain already same. So if we are processing this in the size of 25 only, I don't think there will be any difference in the profit in both the scenarios. So we will look at the numbers as well, how the question is getting solved here. So when we are talking about the break-even point, units per minute per month and profit per month under traditional CVP analysis, how we will do that selling price per unit is 16,000, variable cost is 15,000, contribution per unit. On each cycle I am making how much? 1,000 rupees. Fixed cost that I am in the first scenario I have 20 lakh as the fixed cost. It means to gain this 20 lakh, recover this 20 lakh, how much cycles I need that is my break-even point. So this 20 lakh I can recover it in 1000 with 1000 rupees of a margin. I can recover this in 2000 cycles. So 2000 cycles is my break-even point. But I am making monthly demand how many? 20,000. So it means my monthly demand is 20,000, which is way above my break-even point. So I'll definitely be making a profit. How much profit I'll be making? So I'm selling 20,000 cycles with 1,000 as contribution margin, which means 2 crore is the total revenue that I have, total gross profit I have, okay, or total contribution. You call it contribution or you call it gross profit. Over here, I have 20 lakh rupees of the fixed cost. So, so we can simply reduce 2 crore, 20 lakhs from the 2 crores. 1 crore 80 lakh is the answer. This is my profit per month in the first method, the traditional CVP method. Now, when I'm talking about the ABC, which is the activity-based CVP model, we are talking about the profit per month and the batch size is same. Remember, if the batch size will change, then the things will change. But in this situation, they are saying the batch size is same. So it will remain 16,000. Variable cost is 15,000. Contribution per unit is 1,000 as it was earlier. Fixed cost per month per activity based is 16 lakhs. Remember, this was 16 lakhs in the table that was here. But this 16 lakh should be topped up with additional cost of per batch that we are processing. So break even point per month in units. So in this equation, break even point is fixed cost per month, which is 16 lakhs, plus number of setups. It means the same thing that we did earlier, 800 into 500 setups. So my total fixed cost will become 20 lakh and 1000 is the profit contribution. So I again need 2000 units. So see, there is nothing changed because I mean this 800 batches into 500 is 4 lakh only. So nothing changed actually. So 2000 and the monthly demand units is 20,000. So the total profit that I am making is again 2 crore as the sales, and then I have total fixed cost as 16 lakh this one, and then batch processing cost of 4 lakh, 20 lakh. So my profit margin is 1 lakh 80,000, 1 crore 80 lakh. Now the thing is, as I told you, since there is nothing changed, no batch numbers changed, nothing, no costing changed. So the profit in both the models will remain same. But since if I'm using a activity based model, then I know that my costing is totally dependent on the batch size. Okay. So if I am aware, I'll definitely see that if I will increase the batch size, then this particular cost will be reduced. Like if I am going with 100 as the cycles, 200 will become my batch requirement setups. 200 multiplied by 500 per setup cost. It means I will be able to reduce my 4 lakh rupees of cost to 1 lakh rupees. But if I am increasing the batch, the storage cost will also increase. So I need to factor that in as well. So the activity cost based costing will be able to provide the management more insight about the costing, and then as a management I can take better decisions even if everything is same. Okay. So it is written here like although the BEP break even point units and the profit per month are the same under both methods, the activity based method has brought forward the point that there are 800 setups being performed per month. This would give the management more information to work with in order to improve operations. So if I want to improve operations, I know if I'll increase the setups, the cost will increase. If we'll reduce the setups, the cost will decrease. And you see, just because I did some ABC, that's why the manager may have suggested that let's increase the batch size from 25 per unit to 200 per unit or 100 per unit, whatever it was. So this was the first point. Second part of the question says, the sixth question, second part, analyze the impact on break even point per unit and profit per month when the both batch size of the manufacturing children's care support increase from 25 units to 100 units per batch. Now this is, so earlier it was same, but if I am changing the batch size, the answer will change, which I just explained. So if in that case, break-even point and profit per month under ABC CVP analysis, batch size increased from 25 to 100, monthly setup reduced from 800 to setups reduced from 800 to 200 per month. Remember? So this is the calculation. Contribution will remain same. The fixed cost has increased. Actually, I had to add 1 lakh rupees of my additional cost. So 16 lakh was the cost earlier. But if I am doing the change in the batches, then the 1 lakh rupees of additional cost is there. Now the what is the break even point? Break even point will be my fixed cost, which is 17 lakh, plus the batches will be 200 only with 500 rupees of a cost. So 1 lakh will be here, and then 1 lakh rupees I have saved. So what happened actually? This is actually 1 lakh rupees of a cost, while earlier it was 4 lakhs. So I was able to save 3 lakhs as a management, as a profit. But this 3 lakh will be reduced further by 1 lakh rupees of additional cost. So I have made a profit of 2 lakh rupees, additional 2 lakh rupees. Okay, in short, which is reflected here over here as well. That instead of 1 crore 80 lakhs, I am able to save 1 crore 82 lakhs because I am able to save 4 lakh over here. Sorry, 4 lakh was the total cost. Now it is 1 lakh. 3 lakhs is saving here, and then 1 lakh rupees is gone out for the storage cost. So net profit is 2 lakh increased by 2 lakh rupees if I am changing the batch processing. Okay. How it is being calculated? That for the break-even point, 17 lakh plus 1 lakh is 18 lakh. 1000 is the contribution margin. So 18 lakh divided by 1000 is 1800. I hope it is clear. I mean, this is not a very difficult kind of a thing. Over here as well, if you see, the total costing is 17 lakh plus 1 lakh is 18 lakh. I have made the 20,000 units sale with 1000 contribution. So 2 crore was the total contribution, but the cost is now reduced from 20 lakh to 18 lakh. So 1 crore 82 lakhs. I mean, very simple, but this actually shows you how activity based costing is helping the organizations identifying the right areas where the costing can be saved. Okay, as in financial analyst or as in cost management accountant or as in somebody a professional related to the costing, you need to advise the client on how they can increase the contribution or how they can increase the profit per month. And then you need to know the exact activity where they are involving the costing, where they are incurring the costing. And when you will go to that level, that for each activity, how much is the cost that the client is incurring, that is what is known as activity based costing. Okay, that's the difference between a finance accountant and a cost accountant. For a finance accountant, this 20 lakh will remain 20 lakh per month. But for a cost accountant, they know it is not 20 lakh fixed per month. 16 lakh out of it is fixed, but 500 is dependent on an activity. This activity is the batch size processing. So that's the difference. Analysis. It can be concluded by increasing the batch size. The capacity of the machine can be increased. The time freed by reducing setups from 800 to 200 per month can now be used for other production activities. Since the number of setups will be reduced, so will be the monthly setup cost. Even after offsetting the increase in storage cost, profits will increase by 2 lakh per month. Okay. Consequently, the break-even point has reduced from 2000 units per month to 1800. You see, we are earning 2 lakh rupees more. So for each unit, we are earning how much? 1000 rupees. So we are able to make a profit of 2000 rupees more, which means 200 units. As a break-even point, 200 units have been reduced. This reduction is due to the saving in the overall setup cost due to the lower number of setups. Okay, I mean, this is really, really good. Questions are really good. I mean, I told you in the beginning as well. Whenever I go through these kind of questions, case studies, there is always something that I also learn. And I appreciate that. I mean, this kind of an examination, it should have been there since the starting to make you a better professional, to give you those insights that as a, not as a student, but as a professional, how you need to think. Explain how can the number of setups and the cost of each setup impact flexibility of the milling machine. Now this is how the flexibility will be impacted. So setups reduce the production utility of the machine. A lower number of setups or lower setup time can improve the utilization of the machine. This also gives the company flexibility to keep changing the batches produced at the milling machine to cater to children's cycle and the adult cycle as per its requirement. The other factor that impacts flexibility of the production would be the setup cost. The lower the setup cost, the higher the flexibility to change batches produced at the milling machine to cater to each type of cycle. Okay. Now we are entering the last question of this case study. Seventh question. This is related to the imported cycle. You see the manager, the evaluation performance appraisals of the manager, and how she's thinking that the price should be increased from 65,000 to 85,000. So this is related to that. Evaluate which of the costs pertaining to the 100 imported cycles are allowed to be included in the cost of inventory in the books of the CIL. Okay. So I told you any cost that is not directly relevant to making the inventory come to their shape and the position and the location. If it is not directly associated with that, then that is not something which should be considered as the costing. By saying that it is not considered as the part of the costing does not mean that this is not an expense. It will still be an expense, but it will not be a part of the costing of that particular inventory. It can still be an expense. It can go in the P&L account. Just cut the story short. I mean, this cannot be put in the trading account, if you'll understand this, right? So it will become a part of the P&L account. It will not be considered to reduce your profit, gross profits, but it can reduce ultimately your net profit because it's an expense ultimately, but it's not a cost. Okay. So if you see there were a lot of expenses. So you see, as per the Ind AS 2, the following costs pertaining to 100 important cycles are included in the cost of inventory. So cost of purchase will be there. Yes. Handling costs relating to imports. Yes, because that is the direct cost for import. Import duties, freight expenses, insurance of purchases. Yes. And brokerage commission paid to intending agents. So this is the brokerage commission to secure, to source the inventory. Okay. Now, as the total cost included in the cost of the inventory for 100 imported cycles is 63 lakhs. So this is the total costing. Per unit cost will be 63,000 per cycle. So when the manager was thinking that they'll not be able to make any profit, she was absolutely right. Because even if the cost is 60,000 rupees and you are selling 64 or 65, there are 2,000 additional expenses that you need to incur, right? So there will definitely be no profit. So manager is right in that particular scenario. Salaries of account department, sales commission, and after sale warranty cost are not considered to be cost of inventory. Therefore, they are not allowed by Ind AS 2 for inclusion in cost of inventory and expensed off in the P&L account. You see, very clearly mentioned that they are not part of cost, but they are still expenses, and then they'll be taken to the P&L account. Okay, so the second part of the question, it says calculate the net realizable value of the inventory of CIL relating to these 100 imported cycles. Now I discussed and I told you net realizable value is the actual value at which you can sell the products from the location where they are in the situation, in the kind of position they are. So if that's a, let us suppose, work in progress, then if you are selling this work in progress as it is, then what will be the net realizable value? If there are products which are in the factory, let us suppose they are not packed completely. If you're selling those products without packaging material, what will be the realizable value that you can fetch if you'll be selling them from here? That is what the net realizable value, which is different than the cost. So any future selling expenses that will be allocated on these products, they are not part of uh, my net realizable value. Okay, because if I am running a showroom and these products will be taken to the showroom and then they'll be sold, let us suppose, from in 150 rupees from that showroom, then that 150 rupees, if includes 30 rupees of selling and related cost, that will be reduced from this 150 rupees. Okay. So we're talking about calculate the NRV of the inventory of CIL relating to these 100 imported cycles. So remember there are two types of agreements that the company had for 100. One is 30 cycles and the other one is the 70 cycles. So now we know that the costing is 63,000 per cycle. This is the cost. Now let's calculate the NRV. NRV for the 30 cycles, we are able to fetch agreement of 65,000 rupees, but 2,000 is the additional sales. So the NRV will be 65,000 minus 2,000, 63,000 rupees. So for those 30 cycles, we have 63,000 rupees as NRV and 63,000 as my cost. So there will be no adjustments that will happen. But for the remaining 70 cycles, NRV, we had 64,000 as the selling price, but 2,000 is the expense. So the costing is 62,000 rupees per cycle. Now when we are talking about 62,000, the costing of the cycle is already 63,000. So the cost or NRV, whichever is lower, it means this 1,000 rupees of adjustment on 70 cycles. It means 70,000 rupees of adjustment will happen on this. Okay, on the second part of the inventory. Third question says, calculate the value of inventory of the 100 imported cycles. Value of the inventory will be how much? The 30 cycles will be valued at 63,000, while the 70 cycles will be valued at 62,000. Simple. So this is what is written here. The cost of inventory per cycle as calculated in first above is 63,000 per cycle for 30 cycles. Therefore, these 70 cycles have to be valued at NRV of 62,000 per cycle, which is lower than the cost of 63,000 by 1,000 per cycle. Therefore, CIL has to write down the value of inventory for these 70 cycles by 70,000 rupees, which we discussed in the above option, which is 70 cycles into write down value of 1,000 per cycle. Okay, so this will be 70,000. So this is this particular part. It says like what is the value of the inventory of 100 cycles on March 31st, 24, lower of the cost or NRV. So value of 30 cycles under firm contract 30 cycles is 60,000, 3,000 is 1890. Value of balance 70 cycles is 62,000. So the total inventory value that we will be able to see in the financials is 62 to 30,000. So inventory will be valued at 60 to 30,000. So this, while the total imported cost was 63 lakh, but the inventory will be valued 60 to 30,000 because of the NRV adjustment. Okay. So this was the first case study that we covered, and I think this case study was able to give you some good insights around how is the manufacturing company works. It was able to give you some insights around contribution margin, how what is the difference between the traditional and the activity-based costing, what is just-in-time system, what is the backflashing under the JIT kind of a system, how when we are incurring additional costs, they have been taken care when you are calculating this kind of a system, how the additional depreciation is calculated in terms of a manufacturing company is purchasing new machineries, right? How jet and backlashing I already told. Then when you are doing the import, right? How many, what is the type of cost that is allocated on the inventory and what is the type of the cost that is not considered the part of the inventory? What is the difference between cost or NRV? Simple. How NRV is calculated? What is the impact of that in NRV calculation on the total value of the inventory? What is taken to the trading account to come to a gross profit? What is taken to the P&L account to come to the net profit? Even if something is not part of the inventory, but you have made that payment, then it will be still an expense for the company and it will be taken to the P&L account. I mean, this all is covered through this case study. I mean, I really enjoyed this particular case study. I'm not sure about how many of you have actually paid thorough attention. I know at times it becomes very difficult to focus on what is being told, right? But I think these case studies, they test your patience, they test your focus, they test your attention, and obviously they test your knowledge. So very important to do the homework or to practice these case studies uh, before the final examination. Very important. It will be very difficult for you if you're not handling the case studies or not making thorough notes or not practicing it actually at home. It will be very difficult for you to solve a case study within the allocated time in the during the examination or in the examination hall during when you will be appearing for the CA final exams. Saying this, we will be taking a 15-18 minutes of a break and then we will come back to you guys after 15-20 minutes. Uh, I look forward to connect with you all pretty soon for the second case study and I'll have a humble request to the IT team that we can announce it a break for 15-20 minutes. Thank you.
Sir,
Is it live? मैंने oh, perfect. So, hello everyone. Welcome back after the small break. Now we are discussing the second case study. Second case study is about a company known as ABCD Limited. Now, this ABCD Limited, this case study, when we will discuss, this will give us some relevant points around the accounting and the auditing concepts, some concepts around the import-export licenses, etc. So there are few things that will be different than the previous kind of a case study. So as I mentioned, right, each case study is itself a unique case study and it gives you insights. So I mean, I hope we will learn something from this case study as well. I hope the screen is visible and I'll just increase the font size for everyone's benefit. So this case study 23, it says ABCD Limited is a textile manufacturing company based in Surat, Gujarat. So you see textile manufacturing companies, they get some kind of export incentives. There are a lot of benefits that they get. I can still recall one of the company where we were the auditors. There was some revision in the export incentive rules during the COVID, and it actually impacted a lot of textile manufacturing industries. You'll be surprised to know, and when I started doing the audit or when we started discussions with the founders and promoters, then at that time we were, because of the competition, we were actually was surprised to know that the companies, they are making the sales on cost to cost basis. I mean, the competition is so steep, the competition is so big that they are actually uh, selling their goods at the cost only. And you know, why are they able to survive or how are they able to survive in the market? Because of the export incentives. The export incentives that they are receiving from the government is actually their income, is actually their profit. This is actually what was happening in the textile manufacturing industries during the COVID and all. But when the COVID came, there were certain revisions of the export incentives. The export incentives were stopped, were lowered down to some extent, and it was kind of a killing factor for these kind of manufacturing companies. There are a lot of companies that got impacted because of this revision in the export incentive rules. So now when we are talking about the ABCD Limited, this is a textile manufacturing company based out in Surat, Gujarat, which enjoys a vintage of more than 50 years of good reputation and business. So there is a good goodwill. 50 years of goodwill is also there. The company was set up by Mr. Amar Dev in the 60s in a small room, and as years passed by, it became such a successful and big business that now, after serving domestic consumers, the company has gone global and expanding its business across Europe and Canada through third-party sales from India. Okay, so they are doing a third-party sales. What is the third-party sales? Is basically appointing a mediocre, having a salesperson, having a kind of a channel, or having somebody who is in between, a kind of a third party, which is helping the company to export the products into Europe and Canada. Mr. Rahul Dev, grandson of Mr. Amar Dev. So Mr. Amar Dev started it in 60s somewhere. Now the company has expanded operations from domestic to global. Europe and Canada are the main markets. So they are not into USA or I mean America or the Australia or these kind of markets are still left. But Rahul Dev, who is the grandson of the Mr. Amar Dev, so this is the third generation we are talking now. So the third generation is the managing director of the company and has been following quite an aggressive approach in globalizing their business after graduating from college. So Mr. Rahul is graduate from the college and now he has taken up the command of the company as a managing director, and then he is very aggressive in his approach to globalize the company. He remains in constant touch with CA Nitin Garg. So there is a chartered accountant. They have CA Nitin Group, Garg, who is a partner of Nitin Garg and Company, chartered accountant, and keeps on discussing with him legal compliances and procedures. So, like the CA Nitin Garg is there, so they are the professional consultant or basically legal compliant officers or procedural kind of advisor for them. And Mr. Rahul Dev is in constant touch with CA Nitin Garg to understand. the globalization that he wants to aggressively approach, whether and what level of compliances or the procedures they will need. When I also in my professional capacity, when I also started expanding my markets for various organizations by becoming a manager and then so on thereafter, you see, there was a lot of guidance, there was a lot of knowledge that we initially needed. So if let us suppose I want to penetrate, if I want to increase the scope of services from one country to another country, each country has different laws. They have different export regulations around them, even if it is service or it is like a product. So we need to understand those export regulations pretty much in advance. There are countries which are deducting, the taxation while making the payments. They are calling it like withholding tax and all. This is an expense because if the country does not have proper kind of due double taxation avoidance agreement and all, you cannot claim this as an input in your income tax return of the company. So let us suppose you are selling some services, considering that you will have like 20% of some margin. But if there is a 5% of the withholding taxes there, then 5% will automatically be reduced, and this will become as an expense. So your margin that you estimated will reduce. Further, you may plan to export services to certain countries, but their export regulations are not allowing it. So they are not able to send the data to you, or I mean, there are multiple global restrictions that are in place. So my point is, what I'm trying to make a point over here, that this is the same thing when you are a textile manufacturing company, and you want to go globalize. There is a lot in terms of the global export regulations that you need to learn. And Rahul Dev is actually totally dependent on Mr. C. Nitin Garg, who is helping him with the legal compliances and the procedures in terms of the approach of globalization. Rahul knows the complexities in the business have increased a lot, particularly after advent of GST. Okay, and it's imperative to diversify the ever expanding businesses. So Rahul can understand the business has become more complex. So when his grandfather started the business, it was not GST, right? GST came on at a later stage, and Rahul thinks now when Rahul is dealing with the company, GST is privileged, GST is prevailing over there. So now he knows that the business has become more complex and he needs more consultant or right advices. He understands that their company is well integrated into the web of international business transactions. There is inward as well as outward flow of goods and services between India and other countries. So inward means they might be importing some raw material and then they are outwarding some products. GST impacts imports and exports both. Provisions in the GST laws seek to provide a level playing field to domestic suppliers, vice international suppliers in case of imports. So if you are importing something and then there are, let us suppose, domestic suppliers who are dealing in the domestic markets, GST helps in kind of putting those kind of taxes, those charges, which can which can level the playing field for both suppliers, domestic suppliers, and the international suppliers. Second is to make exports more competitive, right? So in both the areas of import and export, GST is playing a very big role. You see, GST is like like tariff, what Donald Trump is talking nowadays, that they are putting more tariffs so that the import from respective countries that can be reduced and the countries' domestic suppliers or countries' domestic factories or manufacturers may have better potential. So when the goods will become costly, when the import will become costly, obviously the customer will turn towards the domestically manufactured products. And that's what the role of these kind of taxations to control the kind of an economy. So, so Rahul is aware about this. So Rahul is aware about this kind of complexity. Now ABC Limited wants to expand its business and management has found a suitable site which meets its requirements. Now they are expanding the business and the management has found a suitable site. The said site is owned by one of the director of the company, that is Mr. D. So the site which they found and that they think it can help in expanding the business, This is owned by one of the director of the company, that is Mr. D. However, Mr. D was unwilling to sell his prized property to the company. Okay, so this is a company, this is the site of Mr. D, who is the director of the company. But Mr. D does not want to sell this property to the company. The company, however, offers him in exchange a bigger site located in an area having commercial potential. You see, so what company is doing actually, company is kind of entered into a barter kind of a situation, whereby the company is saying that instead of you giving us this particular property in exchange of money, if you're not interested in that, what we can do, we can give you another property which has some commercial potential. It means in the future there will be commercial industry that will be set up over there, and so the prices in the near future will go rapidly, increase rapidly for this new site as well. Lured by the offer, Mr. D agrees to above. Okay, so Mr. D is saying, okay, I'm unwilling to sell the price property, but if you are making an exchange offer, I am okay with that. A property valuer, which is civil engineer by profession, who is having experience of 20 years in valuing properties for commercial banks, is also approached by the company for arriving at value of assets involved in the above deal. So company has hired a valuer to know what is the value of both the properties. The one property that is owned by Mr. D and the other owned by the company. The valuer does not possess any other registrations or accreditations. Now you see the problem is what I can clearly see that this valuer has 20 years of experience in valuing properties for commercial banks. Okay, so we need to see even if the properties of commercial banks may be different than the properties which are involved in this particular equation, because they are commercialized banks, right? And sorry, they are the commercialized industrial properties while they are the bank and all. We will look into this again as the question will progress. Rahul, in order to expand his business, also discussed with Nitin on setting up a subsidiary outside India at Paris for specifically carrying out the import-export transactions easily. And soon afterwards, Rahul sets up a subsidiary at Paris under the name and style of PQRS Limited. Now, see, so we have actually started a company in Paris, PQRS Limited. So, what happens actually, like when you are sending or exporting some goods from here, it becomes very difficult to identify the right customer or sell it directly to a customer. And if even we'll get it, I mean, it takes time and a lot of things. But if we have a company over there, this company can easily place the orders. We can manufacture the goods against that particular order and then we can supply to the company. And this company may have some stock in place, and then if there is any requirement to any customer, wholesaler, distributors, etc., the company holding the stock can easily sell it in the Paris, right? So I mean, this is a kind of a win-win situation. There is no doubt in it. So Rahul, after discussions with Nitin, they opened a company over there in the Paris. Name they have kept is PQRS Limited. ABCD Limited is engaged in the business of manufacturing cloth for other textile companies and non-textile companies. Now the company will be itself carrying out the import-export transactions without involving any third party for export purposes, which it had been doing till now. So if you can recall, the question was saying that for the exporting goods to Europe and Canada, they had a third party. But now they don't need a third party. They are starting their own company in the Paris, so they can do it from there. It applies for the IEC, Import Exchange Export Code IEC, online and gets the same. It's wholly owned subsidiary PQRS. Now you see, it's a wholly owned subsidiary. It means the 100% of the shares are being kept by the company itself. Is engaged in the business of ready-made designer garments. The subsidiary purchases garments and other stuff from its parent company. So what is happening over here? Its wholly owned subsidiary is engaged in the business of ready-made designer garments. So this company which is in the Paris, they are not manufacturing goods or products. They are buying the ready-made garments from the company. The subsidiary purchases garments and other stuff from its parent company, which is ABCD Limited. So PQRS is purchasing from ABCD Limited. The demand for garments of PQRS Limited is very high, and hence to cater to its shortfall, PQRS Limited also purchases garments from other companies. Now you see the supplies that ABC is making, they are not sufficient to cater to the customer demands. So PQRS has decided that they will be buying it from other than ABCD Limited as well. Purchases are made at competitive prices. Okay. During the year 23-24, ABC Limited sold garments to PQR Limited for Euro 13 lakhs. So ABC Limited they sold to PQRS Euro 13 lakhs on 1st January 2024, which is mid of the year during the 23-24. So they sold 13 lakh rupees of goods to PQRS Limited. The cost of these garments was 936 lakh in the books of ABC Limited at the time of sale. So ABC Limited made a sale of 930. So cost of these garments, sorry. So this is the cost of 936 lakh, which is sold on 1st January to the PQRS Limited. At the year end 31st March, all these garments were lying as closing stock with PQRS. So PQRS was not able to sell any of the goods out of it, and it was still lying as the stock in the company in the books of the company. Euro is the functional currency of PQRS Limited, while Indian rupees is the functional currency for the ABC Limited. Okay, that's absolutely fine. So Indian ABC Limited having Indian rupee as the functional currency, while PQRS Limited is having the euro as the functional currency. So 936 lakh rupees of cost of these garments which are sold, and they are sold in euro of 13 lakhs. We will see, like the euro is touching somewhere 108 rupees, 7, 8 rupees nowadays. But when the question was there, I mean, somewhere in 24, the euro was around 80, 85 rupees. So we'll see how what is the exchange that the company is getting in this question. ABC Limited seeks help from CA Nitin on the following issues. Now, ABC Limited, after having all this setup and everything, they are seeking some help from CA Nitin. So these are the facts. During the year, Rahul is finding it difficult to comprehend the GST taxation with respect to export sales made by the company ABC Limited, which are of a peculiar nature. One such sales is where ABC Limited received an order to supply goods to dealer B in Greece. So there is a dealer in Greece. The company finds a supplier C in Singapore and asks him to supply goods to B in Greece. Two invoices are raised here, one by the company on B, okay, in Greece, and the other by C in Singapore on ABCD Limited. So what happened actually? There is a supplier B in Greece, right? So they need some goods. So what happened in this case? The company has decided that they will be outsourcing. I mean, they'll be selling goods to someone in the Greece. The company, like instead of manufacturing, what they did actually, the goods that are needed in the Greece, they find a supplier in the Singapore. So it's kind of drop shipping basically, like purchasing from one place and selling it to the other place. And then they ask the supplier C to supply it directly to B in Greece. Now two invoices are there because B is the ultimate purchaser or customer, I will say. So ABCD Limited must have issued a bill to B, but C has sold supplied goods, so C must have billed to ABCD Limited. So two invoices are there, one by the company on B, which is the sales invoice in Greece, and the other by C in Singapore on ABCD Limited. This is the purchase invoice for ABCD. The point to be noted, or this is the import one and this is the export one. The point to be noted here is that goods do not touch the Indian shores. They are shipped by sea from Singapore to be in Greece. There are many more such kind of export sales, and Rahul seeks C.A. Nitin's help in getting out of the confusion. So Rahul is saying that there are situations, there are type of sales whereby one party is there outside India only, which from where the company is purchasing goods, and then we have another party which is outside India only, we are selling to that particular company. So what is happening? Rather than importing goods to India and then supplying them to the overseas, we are asking the supplier to directly sell them to the overseas. Okay, and in that case, these goods are not touching the Indian territory. For India, it is not like a purchase or sale. In that manner, the question wants to say. So in that case, Even though the purchase and sales will both be my part of my books, the Rahul is confused actually, how the GST treatment will be there in these cases. Second part is second where the kind of suggestion is needed. Rahul seeks CA Nitin's opinion on the GST procedures and treatment for the following two types of export transactions, which he plans to proceed with in the near future. So, Rahul is asking that GST, what will be the treatment of GST on these transactions? The first one is the Rahul has purchased a license to put up a stall in the textile supermarket Global Fair to be held at Milan, Italy. So there is an Italy kind of a country where a fair, global fair is happening, and Rahul has purchased a license and he wishes to send his team to this fair along with their company's merchandise to be displayed over there for professional purposes. So there is a license that is purchased by ABCD Limited, and ABCD Limited's employee will be going to Milan, Italy, and with the merchandise and all, and then they will be displaying it in the for the promotional purposes. Second is he had heard from a dear friend that he could sell his company's products within India, but these could still be categorized as exports. He was eager to know about such circumstances. So they are being saying that somebody told Rahul that there are in certain conditions you can sell the goods to India within India as well, and it will be considered as export. It means you will you will get some GST incentive even if you are selling those goods in India. And this guy Rahul is curious to know what are the situations or circumstances for these kind of cases. Third situation is now it's not Rahul. Third situation is the chief accountant of the company further seeks CA Nitin's time to understand about the valuation and taxability of the following transaction under GST. ABC Limited has imported a special fabric from Paris. Now it is imported. Remember, PQRS is there, but they are not exporting to it in this situation. They have purchased, imported, and files an ex-bond bill of entry for clearing such warehouse goods for home consumption. Okay, so bond bill is there, ex-bond bill is there uh, for clearing such warehoused goods for home consumption. So they have a special fabric and then they ask this to be released for home consumption. ABC Limited imported textile fabric from London and sells them to Panaka Panacea Private Limited. Okay, in India itself before the goods are cleared for home consumption. So the goods are not cleared for home consumption. So it is again, it is like import and then directly exporting. The custom declarations, that is bill of entry, etc., is filed by the agent of Panacea Private Limited for clearance of such goods. I mean, ABC is doing this a lot. Instead of, I will say, purchasing and then selling, they are directly supplying goods from one place to another place. The statutory audit of the company, ABC Limited, is also being carried out by the Nitin Garg and Company. So they are the, along with the consultant, they are the statutory auditor as well. Under the supervision of the engagement partner CA Krit Garg. So in the company, along with Nitin Garg, there is another chartered accountant, which is Krit Garg. So he is the engagement partner. I mean, he'll be the signing partner for this particular entity. CA Krit understands that the auditor he should develop an audit plan that shall include a description of the procedures to be performed as per the SA 315 and 330. Okay, so Krit is aware that an audit plan is required to conduct the audit. The audit plan is more detailed than the overall audit strategy that includes the nature, timing, and extent. When we discuss about audit and we discuss about the nature, timing, and extent, we need to know the meaning of all this, right? So when we are talking about the nature, when we are talking about the overall audit strategy and we are thinking about the nature, nature simply means that what kind of audit procedures you are performing, whether you will be doing inquiry, observation, reperformance, recalculation, or you will be doing TOD, test of details, you will be doing test of effectiveness, or you will be doing analytical testing. What is the nature of the testing that you will be performing? So that is the nature. Okay. Timing is when will you perform it? Will you perform it during the interim period? Will you perform it during the finalization after the final books are prepared? Then what is the timing of it? And extent means what is the extent? I mean, how much will be the volume of the audit procedures? how many samples will be selected. So if you are thinking, you are saying that we will do a test of detail, let us suppose for revenue. If you are doing test of detail for revenue, then that is the nature of the procedure. But when you are saying this test of detail for revenue, I'll be doing interim covering 9 months of a period, then that is the timing. And then remaining 3 months of a period I'll be doing at the time of final audit. This is the timing. But extent is how many samples you'll be selecting when you will be talking about sales, revenue TOD, right? So that is the extent. Nature is the nature of the audit procedures. Timing is when will you perform. Extent is how much is the quantity, quantum that you will be doing of audit procedures to be performed by the engagement team members. Planning for these audit procedures take place over the course of the audit as the audit plan for the engagement develops. He asks Megha in his audit team to work on planning the nature, timing, and extent of specific further audit procedures, and Saurabh on planning of risk assessment procedures. Further, CA Krit knows that the overall audit strategy and audit plan should take into consideration the element of materiality and its relationship with the risk and procedures to be adopted. CA Krit has already developed an audit strategy, and while a detailed audit plan is being developed, he decides that the materiality levels set earlier needs to be lowered as weakness in the internal controls were highlighted in the internal audit reports. It happens. I mean, this is very much practical. So what happens? Let us suppose you are calculating the materiality for a client. Okay. So what happens actually? You realize that the company is profit making, or on the basis of revenue you decided, on the basis of the professional judgment, and on the basis of the your experience, you decided, let us suppose, that revenue is the right benchmark for calculation of materiality. And then you realize that 2 to 5% of the revenue is something that your overall materiality can be there. So you calculated, let us suppose, if you are thinking that the engagement risk on this client overall, not at an SCOTAB or FSLI level, but overall you are thinking that the engagement risk is higher, then you may take lower percentage in while calculating the materiality. So you may decide, like, if the risk is higher, I will go with 2% of revenue as my materiality. But if it is lower, I may decide 5% of the revenue can also be my materiality. So let us suppose you have concluded that revenue is the right benchmark, and then you will be going ahead with 2% as the materiality. Now you realize that the performance materiality, which is kind of a I'll say, the when you adjust your overall materiality to include the factor of conservatism, right? Then, or the margin of safety, I will say, then it is known as performance materiality. So you don't do audit on the basis of overall materiality, but you do audit on the basis of performance materiality. So when you have calculated a performance materiality, now this performance materiality can be 70, 80% or 50% depending upon again your professional judgment of the overall materiality. So if you think the risk is higher, you may reduce the materiality to, let us suppose, 50% of overall materiality. But if you think risk is not higher, and then you can say 70% is the 80% of the overall materiality is the materiality, performance materiality, right? So this is how you calculate the benchmarking and the materiality. At a later stage, while doing the audit, you may realize that the judgments on the basis of which you calculated materiality, they might have changed, right? You came across certain situations, like in this our given case, the auditor has come across that there are few internal control weaknesses which are highlighted in the internal audit report. So control reliance is something that I have a doubt upon. I think the controls reliance cannot be placed. So if cannot place control reliance, I need to keep the materiality lower so that my risk will become low. With a lower materiality, it means now the materiality which I initially thought, let us suppose I decided that I will go ahead with 70% of the overall materiality. Now, since the situation has changed, I have to reduce it to 50%, to give an example. Or let us suppose while doing the calculation of overall materiality, I took 3% of the revenue. But later on, I realized that this is not the right approach, so I'll have to come and revise all my materiality. I mean, I have to make it 2%, let us suppose. So The reason of revision of materiality should also be documented somewhere. And then you need to do the calculation of your material account, whether they are material, they are not, again, to see if things are already in place. So in our question, they say that like he decides that the materiality level set earlier needs to be lowered. Why lowered? Because of risk is there. So the higher the risk is, the lower the materiality is. This is simple. So that you can cover more accounts and then you can do more sampling. The extent of the procedures can increase. The nature of the procedures can further enhance. So subsequently, a deviation from the audit strategy is felt necessary, and he is stuck in a dilemma as what to do. Modify the audit strategy and then revise the audit plan, or vice versa, and seeks his partner CA Nitin's suggestion. So this is the complete case study. In the case study, there are various aspects. We will quickly see. It's a textile company. CA Nitin is the consultant and the auditor as well. For the company ABCD, Rahul is the managing director of the company. Rahul is trying to expand the business to global, and he knows that GST is there on import and export both ways. ABCD Limited wanted to have a property, and Mr. D is someone who agreed, but in an exchange offer. So he's not ready to sell the property, but in an exchange offer, he got agreed. The second part was basically the next part was that Rahul he wanted to export the business, and then he started a company in the Paris PQRs Limited. So it is a wholly owned subsidiary, 100% subsidiary. ABCD got the IECB as well, right? And they are directly now able to sell. And they have sold to PQRS 13 lakh euros of an kind of garments. The cost of it in the Indian books is 937, 6 lakh. Okay, and the whole of the goods are still lying in the inventory. There are a couple of things where specific kind of an consultancy is needed, whereby ABC Limited purchased goods from somebody in Singapore who delivered goods directly to B in Greece. There is nothing which came or routed through the Indian territory. But yes, there was two bills. One is issued by C to ABC Limited, which is a purchase bill for ABCD, which is the import bill, while ABC Limited must have issued an export bill to B in Greece. The second was whereby Rahul seeks his meeting's opinion on these type of export transactions treatment. Rahul has purchased a license and he wants to send his team to demonstrate or to have some display of those merchandises for promotional purposes in one of the global fairs that is held in Italy. So there is a license which is purchased. The next is basically that a friend of his, is telling that even if you sell in certain circumstances, conditions, goods to India, it can also be considered as export of goods. So he wanted to know that what are the conditions for that. Then there is an accountant who wants to seek some advice on the fabric, whereby they sold this particular fabric without getting the clearance. I mean, home consumption clearance is still not there, and then they sold it, right? So they want to understand what is the implication, and then there is a revision in the audit materiality and how to go about it. So this is basically the case study. So you see, when we discuss about these kind of case studies, we always tell these case studies are basically a combined a kind of a situation, a combined case studies for various aspects that you will be reading in your various subjects and then various chapters and concepts. So it will help you kind of refreshing and thinking like a professional. It will help you telling you how this all is integrated to one place. How this all, I mean, CA subjects or study that you are going through, how they can be coming together to solve these kind of practical world situations. This is what the IBS exam is all about. Since now we have gone through the study, now let's go quickly and see the kind of questions and answers. The first question is, which of the following is responsible for issuing granting IEC? Who issues? I mean, IEC is basically an import-export code. So who is issuing it? Custom. It's not the custom department. It is related to the foreign trade. So Directorate General of Foreign Trade, DGFT, they issue it. It is not the promotion industry or the MC. So always remember IEC if you want to apply, who will issue it? DGFT, the Ministry of Commerce and Industry. We'll keep on looking the solutions as well. So you see, DGFT is the correct answer. Second is, what should CA Nitin advise CA Crit to do when the letter is stuck in the revision dilemma of materiality levels set earlier? Okay, so in this case, what do you think? You see, I need to change my overall strategy first, and then thereafter prepare the audit plan in with the strategy. Firstly, prepare the audit plan and then modify the overall strategy in the in line with the plan. You see, what is the audit strategy? Audit strategy is when I'm deciding that how much is the materiality, okay, and on the basis of that materiality, what are the accounts in the financials which are material for me as an auditor. I need to then, once I have sorted that out, I need to make a plan on what is the plan to address those material accounts. Okay, what will be the approach, what will be the nature, timing, and extent, who will be performing, whether I have the right skill set, whether an expert will be required, whether the team that I am deploying will be sufficient to complete all that particular thing. So this is all plan. Strategy is that what is that I want to do, and plan is how I'm going to do that. Okay. So if you come across in this kind of a situation, this is very obvious that you have to change the overall strategy, because if the strategy will be right, then only plan will make some sense. You cannot make a plan and then change the strategy. So you cannot have like 10 resources and you are thinking that I have a lot of a very big team, so I can complete more samples. So just because I can complete more samples because I have a bigger team, let's reduce the mortality. Means let's change the overall strategy. That's not possible. Okay. So firstly, we'll need to modify the strategy and then plan. Modify the audit plan and strategy simultaneously. Go with the change in anyone as these are not interrelated. I mean, so clearly the first is the answer. Whereby you need to change the overall strategy and then the overall plan. Okay. So this is the answer. We are moving to the third one, which says like statement one is GST is leviable on the fabric imported from Paris while filing for its clearance. Okay, GST is not leviable on the sales made to the Panacea Private Limited. So you see, this is my import. So GST will definitely be leviable on that. But when we are selling it to the Panacea Limited, it is before even clearance is done. So we have sold it. So GST will not be applicable. But in this situation, both the statements are correct. Let's see how the yeah. So both the statements are correct and independent of each other, right? So let's go into the reasoning. How the reasoning is there. GST is not leviable when goods deposited in customs bonded warehouse are sold before clearance, right? This is like more or less like an export. The kind of same situation that I imported goods without touching the Indian boundaries, Indian territory, it is exported. So in that case, GST is not applicable. The same is leviable when ex-bond bill of entry is filled for clearing such warehouse goods for home consumption. So when I'm clearing it, that they will be, I mean, they are actually a domestic consumption, then the GST will be levied. Otherwise, it is just like an export. Government wants to incentivize, which I started my uh, case study with by saying that there are a lot of export incentives, and then the textile industry at times I have seen they are surviving because of those incentives. Okay, so they are saying if the goods are directly sold without clearing them for the home consumption, they are equivalent to the export, and then GST will not be there. But if they are applied for the home consumption and post clearance, that GST will be applicable. So both statements are correct. Considering the transaction with Mr. D, one of the directors of the company, which of the following statement is more appropriate? So in this case, let's see what are the statements that are made by the question. The transaction with Mr. D is permissible, subject to certain conditions laid down in the Companies Act. However, the company is not acting in accordance with the law by approaching a valuer referred to in the description. Such a valuer needs registration from the Actuary Institute of India to act as a valuer. Okay. So they are saying you can enter into the transaction, but valuer is not the correct person. B is saying that the transaction with Mr. D is permissible. Again, so first was also permissible, second is also permissible. The company is acting in accordance with the law by, and then they are saying the valuer is also correct. So in the first, transaction is permissible, valuer is not correct. Second is transaction is permissible, and valuer is also correct. Third says the transaction with Mr. D is permissible subject to certain conditions. However, the company is not acting in accordance with the law by approaching a valuer referred in the description. Such a valuer needs registration from Insolvency and Bankruptcy Board of India to act as valuer. Okay. Third is saying this. D is saying the transaction with Mr. D is permissible subject to conditions. However, the company is not acting in accordance with the law by approaching a valuer referred to in the description. Such a valuer needs to be registered. So they are saying valuer, where should the valuer be registered to enter into these kind of valuations? The answer is that they should be registered in the Insolvency and Bankruptcy Board. So the C is the answer. The reason is the description provided in the case study is an example of non-cash transaction with directors of the company. Such transactions are governed under Section 192 of Companies Act. I told you this is kind of a barter that happens. The company can undertake such transactions after fulfillment of conditions prescribed under Section 192, like prior approval of such arrangement in the general meeting accorded by a resolution. Further notice of such a resolution also needs to indicate value of assets involved in such an arrangement calculated by a registered valuer. Such a valuer needs qualification and experience as described in Section 247 and relevant rules and needs registration from Insolvency and Bankruptcy Board of India to act as a valuer. The valuation examination is also conducted by IBBI. Okay. So basically, in this kind of a barter transaction, it is allowed within the director, but it has to be given a proper notice with GM for GM. It has to be a part of the agenda, and then when you are doing that, there is the value as well. You need to mention that what the value of exchange, what is that, and that value has to be calculated by a valuer who is registered with IBBI. Okay. Then we are moving to the next statement, which goes like in case of trade involving B in Grain and C in Singapore, invoicing should not have been done by ABC Limited in India. So they are saying the invoicing should not have been done. I mean, which is apparently wrong. Without invoicing, it is not possible to enter into a transaction. Statement 2 says value of such shipment has to be included by ABC Limited in the value of exempt supply for the purpose of reversal of ITC under Rule 42 and 43 of CGST. So they are saying they should be applying in the value of exempt supply, right? So value of such shipment has to be included by the value of exempt supply. It is not also an exempt supply. So both the statements are wrong. The reasoning for this is why they are both incorrect is that the third country shipments or triangular trade is a common practice in international trade, whereby goods move from one country to another without touching India. Only invoicing is done by the registered person in India. Paragraph 7 of the Schedule 3 of the CGST Act provides that supply of goods from a place in the non-taxable territory to the another place in the non-taxable territory without such goods entering into India is treated neither as a supply of goods nor a supply of services. Thus, there is no GST liability on such sales. Further, value of such third country shipments is not included in the value of exempt supply for the purpose of reversal. Okay, they are not kind of exempt. They are not considered as sale from the GST perspective. Okay, moving to the descriptive part. I mean, they're also very simple. We'll quickly cover them up. Provide the accounting treatment with respect to transactions between ABCD Limited and PQRs Limited. So there is a transaction that happened. There is one side the goods were sold for 900 and something crore rupees of cost, and PQRS they kept in their books with 13 million euros, what I think we call, in respective books of accounts. Also show its impact on consolidated financial statement. So we need to see how this will be recorded in the books, individual books, and if the consolidated books are there, then how, what will be the treatment. So when we sold the goods, the exchange rate was 83, but when we are closing our financials, the exchange has improved. So for ABC Limited, there is no doubt there is a profit of 2 rupees because now the receivables have actually increased without doing anything. So there will be a foreign exchange gain. Okay, but when we will do a consolidation, I mean, that is not something that we will be uh, booking at a consolidated level because this is the same entity, right? In the same manner, any profit that we have booked while making sales to PQRS, that is also not relevant in this given case. Okay, so let's see how the calculation is and according. So ABCD Limited will recognize sale of 1079 lakhs, which is 30 lakhs euro into 83 is the exchange rate. So this is the sale. The cost was 936 lakhs. This is what they mentioned. So 143 lakhs is the profit. So profit on this inventory, which is my alone inventory. At the year end, this is lying with my counterpart. So I need to reverse the profit on this inventory as well. Okay. On balance sheet date, receivable from PQRS Limited will be translated as the closing rate, that is 1 euro 85. Therefore, unrealized forex gain will be recorded in the standalone profit loss of 26 lakhs. 13 lakh euros, 2 rupees of benefit. So what will happen actually? If you'll record the sales, what is the entry? So this is the debtor PQRS to sales. Amount is 1079, which is calculated the sales amount. And at the closing, 31st March, what is the entry? You will again debit the receivable with 26 lakh, and you will book the foreign exchange difference. This is the standalone books of ABCD Limited. Okay. Accounting treatment in the books of PQRS Limited. Functional currency is euro, so they will book 13 lakhs in their books, right? And that will remain the same. So, I mean, the exchange difference will not make any difference in the books of accounts of PQRS because they are just maintaining euro in the euro books only. So 13 lakhs will remain 13 lakhs at the year of the year end as well. But if we are consolidating the financial statements, now what will happen? We need to eliminate the profit that is generated. So on this particular equation, 143 lakh rupees of profit is there, which is not a profit at a consolidated level because I can't earn by selling to myself. Okay, so I need to kind of reverse that. How that will happen? The closing stock of PQRS Limited will be recorded at lower cost or NRP at the year end. Cost is 13 lakhs in euro, 83 rupees was the exchange, 1079. This is what the uh, cost was, right? NRV assuming same, so 1105. So they are saying in the PQRS books, this is the kind of position. So they are saying 1079 is the total cost. But what I'm trying to say or tell you guys that this 1079 includes my profit as well. So what I will do, I will reduce this both components 936 and 143. So at the time of consolidation, the second element according to rupees 143 lakhs will be eliminated from the closing stock. So we will reverse this 143 because this is a consolidated profit. But you see, this is the only like kind of an impact on the closing inventory. Because if you have sold something during the year, then it is actually a realized profit. Then that is not that will not need any kind of adjustments. This is just the inventory which is being held. Any profit on the unsold inventory, closing inventory, that is what we are going to reduce. But any if they would have sold anything out of this particular inventory, then the whatever profit they are able to recognize, that is a realized profit. Will not be removing the impact at a consolidation level because that's a actual profit in the books of the company. So we do this adjustment we call in the accounting or auditing, we call it a top up entry, right? At times, and then this is done for the closing stock which is in the book. Okay. As regards transaction with Mr. D, one of the directors, state few audit procedures pertaining to transaction to be performed by CA Clerk. I mean, so this is the same thing which we discussed above as well that like MRL, this should be taken in the MRL. The auditor should check compliance the the general meeting is there, whether the agenda included this, the value of asset is included, and then the valuer who was there, whether that valuer was registered or not, or everything. So these are the audit procedures basically. So when you will make an audit plan for these kind of transactions, you will write down that we will perform all these procedures, and then who will be performing it in the audit plan, that is also mentioned. Okay, so this is the kind of like answer to this. Discuss probable purpose of such audit procedures also. What is the probable purpose? Requires the auditor to report whether the company has entered into any non-cash transaction and directors. So section 192 says that it has to be mentioned, and whether the 192 is compiled with or not. And there is a requirement for non-cash transactions in the CARO. So the auditor has to report. Last question is discuss implications of proposed transactions relating to sending of companies merchandise for display in textile fair in Italy. So this is not a sale. If it is just like a display, it's not a sale. Also discuss under what circumstances goods sold within India can still be categorized as export under GST laws, and also touch upon taxability of such transactions under such law. Okay. So we'll quickly see. You see, in the first kind of a situation, Rahul has purchased a license to put up a stall in the textile supermarket global fair to be held in Milan, Italy, and he wishes to send his team to this fair along with their company's merchandise. Sending taking goods out of India for exhibition or on consignment basis for export promotion. Right? They have clarified that the activity of sending taking goods out of India for exhibition or on consignment basis for export promotion, except when such activities satisfy the tests led in Schedule 1, does not constitute supply. So this is what I was telling you. This is not a supply. Does not fall within the scope of 7, as there is no consideration at the point in time. Since such activity is not a supply, the same cannot be considered as zero rated supply as per the provisions. Thus, activity of sending taking specified goods out of India is not a zero rated supply. That being the case, execution of a bond or LU2 as required in the section is not required. Okay, so there is no such LU2 etc. required. The second is he had heard from a dear friend about the conditions. It takes place in deemed exports. So this is a very well known kind of a phenomena in the GST, deemed export. Deemed export refers to supply of goods manufactured in India which are notified as deemed export under section 147. Such supplies do not leave India, and the payment for the same is received either in Indian rupees or in a convertible foreign exchange. Following categories of supply of goods have been notified as deemed exports. Supply of goods by a registered person against advance authorization. Supply of capital goods by a registered person against export promotion. EPCG, AA, like EOU, export oriented unit. Supply of gold by a bank or public sector undertaking specified in notification against AA. Right. So, if these are the conditions, they are very well mentioned anywhere and everywhere. So, you can clearly reach out to the relevant section and you can write down all the conditions which are available there. What is the taxability of deemed export? Deemed exports are not zero rated supplies by default, unlike the regular exports. Hence, all supplies notified as supply for deemed exports are subject to levy of taxes. That is, such supplies can be made on payment of tax and cannot be supplied under a bond. However, the refund of tax paid on the supply regarded as deemed export is admissible to either the supplier or the recipient. Thus, the application for refund has to be filed by the supplier or the recipient of deemed export supplies as the case may be. Okay. So they are saying if you have purchased or if you have taken any services to manufacture the goods, right, which are supplied to the deemed export kind of situation, then that input on that particular goods can be taken as a refund, and the application for that refund can be filed by the supplier or the recipient, right? So, this is the second case study. It actually helped you clearing some audit related phenomena and then some GST related concepts. I think I found this particular case study is also something that's really different than the first one. While the first one was more focusing on the manufacturing, the contribution margins or probably break-even points, etc. In this kind of second case studies, we have gone through the auditing concepts, accounting concepts, I mean GST, export regulations, etc. So, I mean, they both have been absolutely different from each other, covering different concepts, different subjects, different chapters, and everything. Okay. So, I think you learned something new from these case studies today as well, and you got some idea on how to prepare for exam, how to write exam, how to give the answers and all, how to handle these kind of case studies, and how to behave like a professional when you are dealing with these case studies. They are again not only I will say questions or a case study, but they are the practical real life scenarios. And then the question is actually asking you, if you are a consultant, professional consultant, how and what will you do in these situations? How will you handle? How will you solve these problems? What is the response that you will be giving to the client? And that is the whole purpose of this IBS as a session. I mean, thanks a lot, everyone. I will call it an end to the today's session, and I'll definitely look forward to seeing you again in any other session pretty soon. So I'll go back to the technical team, and technical team, if we don't have any questions, then we can wind up the session, today's session. Team, are you there? Yes, over. Thanks a lot, everyone.
Thank you, sir.
Thank you. Bye. Good night. Bye.